Hello, it's Luther Wilson III here on Monday, August 19th, 2024. Real estate professional here in the Kansas City market, representing for Upside Property Services. And on today's video, I want to talk about the 3Ds for seller financing, or the 3 scary Ds of seller financing, as I like to call them. And as some of you may know, my specialty, or at least one of my specialties, is seller financing and creative finance transactions. And I've been doing those on and off for the last 10 plus years. And I've had the opportunity to work with investors as a realtor and a property manager. And I myself, as an investor, doing transactions on my primary residence, as well as investor transactions with partners, clients, and so on. And lately, there's been more excitement. There's been a bigger push towards creative finance transactions and seller finance deals. And I think a lot of that has to do with the different market. Things have shifted. And with lower inventory and higher interest rates, real estate, of course, is super competitive. And on the residential side is where I focus primarily. I think a lot of investors have been forced to pivot and to do things that are a little bit different than what they were doing before, because what they were doing before really isn't profitable anymore. If investors are looking at buy and hold, long-term rentals, or even short-term, medium-term rentals, or they're looking at fix and flip, it is quite a bit different now than it was 6 months or 12 months or 2, 3, 5 years or longer. And so in order for us to be able to stay relevant and stay active and be able to do deals that are profitable, then we've got to get creative, and we got to think outside the box, and we got to stay on point with our operations and so forth. And so over the last 2 years, especially, me and my team, my mentors, have been able to do a lot more seller finance transactions. And we've seen newer investors and some seasoned investors do it in ways that may not be as productive or efficient. And we're starting to see more regulation come into play. All right. So just last week, I saw an article that was posted on a real estate investor Facebook group, and it talked about contract for deeds, which is one of the number one ways that we do seller finance transactions here. And the CFPB, the Consumer Financial Protection Bureau, has put out a study. And this was just their most recent one. And I'm sure they've done more in the past, and they'll probably continue to do more in the future, because again, seller finance transactions are gaining popularity and more people are, trying to do them. And the study was just gauging residents, property owners, investors, and so forth, and how they were doing their contract for deeds. And this was done in Minnesota. And at this point, we'll have to monitor the situation and see how things play out. But it goes back to, understanding how to structure and handle these types of transactions. If you are an investor wanting to do more of these, or maybe you're doing your first one, or if you're a property owner and a buyer approaches you or presents an offer that is creative, it's going to be good to at least have a general understanding of how these work. And definitely, if you're going to do them and do multiples, you want to have advisors or someone on your team or someone working closely with you, or even a partner who understands these pretty darn well, so you don't get caught up in a legal situation. All right. And so again, it comes back to handling them and structuring them a certain way. And whether you're the buyer or the seller, making sure that you're on the same page with whoever's across the table from you, and that things are being disclosed. Okay, that's kind of how I look at it. And so the 3Ds, okay, that most property owners and investors are concerned about when they are doing or looking to do a seller finance transactions. The first one is defaults. The second one is Dodd-Frank. And the third one is the due on sale clause. Okay, so I talk more now than ever before. I've done some presentations over the last couple years, and of course I'm doing more videos and lots of social media posts about seller financing. So I'm having a lot more people connect with me and reach out, asking about how certain aspects of it work and why would I want to even do it instead of just renting the house out. And one of the biggest questions that comes up is, well, what if you do a seller finance transaction and your buyer stops paying? What if they go into default? Well, it depends on how you've structured the seller finance transaction. Okay, so in our case, Kansas City market, Kansas and Missouri, contract for deeds have been really favorable with our buyers. Okay, so that's majority, all of mine that I own as an investor, and we produce cash flow on them. All of mine are contract for deeds. And so in the event of a default, I got two particular buyers right now who are on the verge of default. One of them hasn't paid for August quite yet. Hopefully they will. And then the other one had gotten behind, not consecutive months, but over the course of a 2-year period had gotten behind by 2 months. And then it was about to be a third month. And of course we were being gracious with the buyer, the second buyer, and we were working with him, communicating with them. He ended up getting current, but now he's got to make the August payment. So how do we handle that? Okay, so first thing is communicate. Reach out to the resident, reach out to the tenant buyer, whatever you want to call them, or however you, or depending on how you have the paperwork structured, there are certain terms that you need to refer to these residents as, but communicate with them, reach out to them, figure out, what their situation is, what their plan is, and how they can get back on track. Okay, so in our case, on all of the contract for deeds that I've done over the last 5 years, there's been almost 40 of them. The average down payment amount that I've received from these contract for deed, land contract, installment agreements is over $22,000. Okay, so if I have a buyer that puts $8,000 down, $15,000 down, $25,000 down, and they start to fall behind, I am going to be a little more gracious with them, and I'm going to give them time to get current, or maybe sort things out, or figure out how we can work it out with them. And so that is just being mindful how you handle it. A lot of investors have a hard time with rentals, and they may get a little bit impatient and want to jump the gun, but you got to be mindful of the situation. And and how I operate, I want to keep them in the home. Okay, if I need to bring someone in to loan them money, if I need to get them plugged in with some type of organization that can help get them on track, or if I need to work out the payments with them and maybe tack it on the tail end of the note, or push that defaulted amount to the back end of our agreement, then I'm gonna try to sort it out so where I can keep them in the home and that they can continue to pay, hopefully get back on track and stay on track, and eventually purchase the house outright from us or refinance, however that looks. And so depending on how you have structured things, whether it's a contract for deed or a lease option, you can offer cash for keys. Okay, you may have to file eviction, get an attorney involved, go through the court process. Okay, and if it comes down to it, depending on how the residents respond, or if they push back, you may look at doing potentially some type of foreclosure. It could be a forfeiture of some type. It wouldn't necessarily be a deed in lieu of foreclosure because they wouldn't have the deed in this case, but it could be some kind of forfeiture or foreclosure. So again, I want to go over some of the basics and how, I see it and how I've been able to work through some of these situations. And you're going to want to talk with advisors depending on where you live, depending on where your investments are located, what market you're in. There's going to be different procedures and so forth that you have to go through depending on the county. So again, I have advisors. One of my mentors is my father. He's been doing these creative types of transactions for 34 plus years. I have a mentor who I consider a mentor. He may not know it. His name is John Burley. I've been to a couple of his events, and he's been doing this type of stuff for 40 years. And in Kansas City, besides my dad, there's people that I surround myself with. There's a real estate professional who's done mortgages for 40 plus years, and he was an appraiser before that. And he also was an investor during that time too. And so these are the types of people that I recommend that you get around, find good mentors, learn as much as you can, and have good advisors in your corner. So that's a key part. Fortunately, because of how I operate, how I communicate with my residents, because I have good advising, I haven't had to deal with a default since 2018. Okay, so I've been pretty fortunate. Again, we push to make sure that these are handled and structured properly, and that starts from the beginning with the property that you purchase, how you buy it, what location it's in, and then how you promote it, and then how you find the residents and how you place them in these properties. It's a process. There's systems that we have in order that allow us to be more effective. Okay, so defaults, that was the first thing. Again, it could end up going a number of different directions, but that's a brief overview of how you or me, how you might look at handling a default situation, okay? The next one I want to talk about, the second D, is the Dodd-Frank Act, okay? So Dodd-Frank is an act, it's a piece of legislation that came to be after the mortgage crisis in 2008. I think it really started to pick up steam in 2014, okay? And the Dodd-Frank Act pretty much limits, or its intention was to limit real estate finance or, creative seller finance types of transactions. At the end of the day, it was ideally supposed to protect the consumer, okay? That's what a lot of it is about. So the Dodd-Frank Act, again, you're gonna have, it's I think 1,000-page, maybe 800 or 1,000, maybe more page document. I haven't read through it. I've done a little research to dig in. I understand some of the basics of it, and it's to me, you if you're gonna do private mortgages, if you're gonna do seller financing, depending on how you do them, okay, there's a certain number that you can do per year, and I believe that number is 3. And if you do more than 3, then you're gonna want to look at getting a mortgage loan originator or RMLO involved, okay? In Kansas and Missouri, we've been pretty fortunate. Again, the contract for deeds that we do, the lease options, the few that my colleagues have done, we've been okay, and we structure and handle them. So look at whatever market you're in, figure out, okay, if I'm going to, you have to make a choice on each of these, how you handle your transactions, okay? Just because you haven't gotten caught or, doesn't mean that it's not going against certain guidelines. So you just have to be mindful and choose how you want to operate. If you're going to do a lot of these, which I plan on doing in the future, I'm looking at doing lease options. I'm looking at doing, of course, continuing to do contract for deeds, a certain number per year, and I may look at some true seller finance transactions. So Dodd-Frank, that's the second big D that a lot of investors seem to be more concerned about, which to me, again, you have to choose how you want to operate based on your market, your risk tolerance, and how much volume you want to do. You got to protect your assets and protect your residents and so forth in there. So that's the second D, is Dodd-Frank, okay? So the third D is due on sale, all right? So the due on sale clause is a part of almost every mortgage, almost every conventional mortgage and non-conventional mortgages. There's a due on sale clause that states that the mortgage company, in the event of a resale where title transferred or the deed gets transferred from the person that took out the mortgage to someone else, that the mortgage company can call the loan due, which means that the full amount, the remaining balance of the mortgage, you'd have to pay off. I've been pretty fortunate. I haven't had a loan called on me yet. I say yet because, again, I plan on doing quite a bit of volume in the future. Loans do get called, okay? It may be rare depending on what market you're in and how you're looking at things, but let it be known that mortgage companies do call loans, okay? And I think now more mortgage companies, with the legislation, with the tax on landlords, it seems like all the different things happening in the market, mortgage companies are going to be looking at, okay, where we at? Let's dig into, who's on the mortgage, who's on the deed, what interest rate are they paying? Because, my understanding is that a big part of it was for mortgage companies to protect their investment, to protect their interest. If you own a property or if you're buying a property subject to the existing financing, you have to be mindful, okay, the mortgage could get called, okay? So if you're planning to do a certain number of these or a large amount of these, are you going to be willing to make that call, or are you going to have ways of satisfying the mortgage company? However that may look. It could look like you contacting, let's say you're an investor and you bought a property subject to the existing financing and you've owned it for a year and a half or longer, and you get contacted, you get a letter from the mortgage company say that, hey, we've seen that title is transferred, the deed is no longer in who we made the mortgage to, we're going to call the loan due and it needs to be paid back in full within 30 days. Are you going to be able to make that call? Are you going to look at, okay, if I was in that situation, right, I might look at refinancing. I might look at deeding the property back to the previous owner who's on the mortgage. Or I might also look at, if I had a good enough spread or equity there, I would look at selling my interest in the property or selling the note. Or I might also look at having the residents who are in the home get their own financing, okay? Or maybe they could sell the property. Again, it depends on, okay, is it a lease option? Is it a contract for deed? Is it some type of hybrid? How is it structured? How is it being handled? You have to make these choices as a business owner to determine how are you going to make that call if need be. How are you going to satisfy the mortgage company so you can get back to business, okay? So there's a lot that I could cover. I could probably do a video for each one of the Ds, the default situations, the Dodd-Frank Act, and the due on sale clause. but I just wanted to give a brief overview of those, hopefully to dispel some fears, dispel some myths. This is the reality of real estate investing. And I want to, continue to put the word out there because we're seeing more seller finance transactions. We're seeing the powers that be, lawmakers, come at property owners, and the regulations across the board seem to be changing. So if you're looking to do these, you want to be mindful and again, have good advisors and mentors around you in your corner. You can partner with investors, you can do different things and make sure that, if you're going to be increasing the volume of seller finance transactions, that they're done well. Okay, so not only to protect your interests, but to also look out for the residents that you're putting in these homes. Okay, so at the end of the day, like I talk about capital and financing, of course, and how important it is to have that beforehand and having reserves, okay, for situations like the defaults or the due on sale clause or Dodd-Frank situations that may come up, because a lot of times, when notes get called or when mortgages, a mortgage company calls the loan, it might be, and some of the things that I've heard from people that have, I don't know if they've tried to scare me or get me concerned about it some way, but I'm like, okay, so the mortgage company called the loan. Was there a balloon on the mortgage? And that person may say yes. Okay, so of course, you got a 6-month, 12-month, 2-year balloon. The loan's gonna get called because that's what you agreed to do. You agreed to pay it off in that short amount of time. And then in other cases where I've heard that mortgages have gotten called, it's because the investor or whoever owns the property or bought the property stopped making the mortgage payment. Hello, come on. Of course the mortgage company is going to take some kind of action. So we got to just try to be mindful, more logical, and again, treat your investments as a business. And the financing and the capital piece, I think another thing that I want to touch on before I go is a reason why more regulators are looking at seller finance transactions, and there's stuff that's been passed in Kansas, and I could go down a rabbit hole, but a big part of it is there's been bad actors, bad players, investors that either didn't know any better or they're choosing not to operate in good faith. And so making the mortgage payments is key. All right. Having good underlying debt. Okay. So when I talk about mortgages and financing, I push hard for 30-year fixed rate mortgages for a reason. The non-QM loans, okay, is great for investors, right? If somebody reaches out and they want me to help them with a transaction, I'm going to ask them a series of questions, okay? Do they even own the property? Is there short-term debt on the property that needs to be paid off last year or last month or within the next 5 months, okay? And what's going on with the property? We need to understand this beforehand, prior to us trying to find a resident or a family to place in this home, because we don't want them to be in a messed up situation. If an investor reaches out and those questions are no, or if the questions that I ask, they have short-term debt on the property, right? The property needs a ton of repairs. I'm gonna wait. I'm not gonna be able to necessarily help them find an owner finance family, maybe another investor. Okay, so these are things to think about. Again, I could go on, but I wanted to cover some of the fears that investors and property owners have about seller financing, because we're in an interesting market right now and we may be in this holding pattern for a while. And so for a lot of property owners and investors, doing something creative may be the only way for them to get out and to be profitable or to break even and not lose money. So as we're seeing more of these opportunities, keep us in mind. I'm going to be doing more videos in the future talking about investor financing, operations of a real estate investment company, okay? How we, I say we, me, my team, my partners, my clients here in the Kansas City, structure and handle our seller finance transactions. Most of what we do, again, is contract for deeds. I can break that down in a future video, as well as how I'm looking to do lease options in the future as well. So plug in with me. Thank you for your time. Peace.